Vivek, hi, good morning. Thanks for joining us today, Kartik this side. Let's take two scenarios. One scenario that crude oil continues to be below $100. I'll not say that, let's assume the best case scenario that it stays within the 87, 88, under 90 range. Let's assume it stays at $100 a barrel. Then I think that is a price that all global economies have factored in when they are making their projections for inflation and rate cycles, as central banks would want to sort of continue with. But second scenario, so question one, if $100 and below is the crude oil price, then is there going to be any other impact on global economy with the ongoing war? And the second being that the peak of 120 that was arrived at during the start of the Russia-Ukraine war last year, if we were to come back to those levels or beyond those levels, then how drastically does the inflation print change?
Hi, Kartik. Good morning. So I think that's a fair range that you said, because most of the market participants at this point in time are working with a $90 to $100 range as far as Brent is concerned. Does that upset the arithmetic? If that's the question, I would say that probably does not, because it's kind of baked in most of the forecasts that the markets are currently making, as well as the policymakers' forecast. In case of RBI, they are slightly lower in terms of their projections. They are penciling in close to $85 to a barrel for the year as a whole. And for the first 6 months of the year, the oil forecast was actually lower than the forecast that they were making. So even if oil were to trade at 90 or closer to 90 levels, their forecast of $85 to a barrel for the year will be met. Now, if it were to be in the 90 to 100 range, I would say it's not going to upset the arithmetic a lot. Reason being, the previous financial year, we were at 95. And if we end somewhere close to that level, then we would be very even Stevens as far as the last year's scenario is concerned. So most of the metrics that you would be looking at would be in percentage terms. And when you look at it from percentage terms, it does not really change a lot. The picture does not really change a lot. So what will change in the interim is the worsening of price situation vis-a-vis the previous quarter. The previous quarter, the markets were in the comfort zone of 75, in fact, less than $80 a barrel. So that comfort zone, you are not no longer in that comfort zone, and you are now in I would say an amber zone. You're not really a red zone yet, but
Okay.
kind of an amber zone. So what really would be a red zone? A red zone would be the thing that you highlighted, something closer to 820 or maybe above would be a red zone for the global economy. So why would it be? It would be because there is even without this, there is an expectation of a slowdown. And if oil prices were to escalate, the slowdown will only get worse. So that is something that we'll have to keep in mind, and we would be exposed from the trade angle. Our current account deficit will feel that pinch. Our inflation metrics, unfortunately, might not reflect the true reality, Kartik, here, because we've got two sets of inflation indices. One is WPI, one is CPI.
Yeah.
And all said and done, we are, going to enter the busy election season very soon. So the government will probably use its discretion. When I say government, I also include the oil marketing companies, because they are government-owned entities.
Right.
And so they would use the discretion to decide how much of the pass-through is likely to happen during the upcoming election season. So it is going to be discretionary at this point in time. And I guess while the impact will be there, the impact could be borne by either the government or the oil marketing companies on the retail side. On the wholesale side, the impact could be closer to, let's say, complete. So that's probably the reason why we would expect a much faster acceleration in WPI inflation, which is the wholesale rate, where you will see the impact getting captured on a regular basis. On the retail side, it's likely to be muted. So, for example, last 1 month of picture tells us that the government is in the mood to cut down prices. If you look at LPG, and there was an expectation that
Right.
in the upcoming election season there could be a possibility of government also lowering excise duty on petrol and diesel. Now, if oil prices were to stay elevated, then maybe that expectation will get curbed. Maybe that is something that might not play out. But as far as the pass through to CPI inflation is concerned, we would not be very optimistic that's something going to happen within the next 4 5 months.